morning, everyone. Thanks for having me present at this conference. Special thanks, of course, to Liz for organizing today, and of course, Urbana. About 6 years ago, we started a partnership with Urbana, and they've been fantastic to work with. Brendan and Tom have been super supportive partners for us, and hopefully it's been a good experience for them as well. I thought before I get right into Evolve as an organization, it'd be worthwhile to tell you a little bit about our people, because I'm a big believer that it's people that are the backbone of every business and your team. This is some of the members of our team, and you know, just to kind of echo what some of Liz said, prior to putting Evolve together, I ran Canada for WisdomTree, which is one of the world's largest ETF providers. Prior to that, I ran the retail business for Fiera Capital, which is actually one of the country's largest asset managers with about 200 billion in assets. And then prior to that, I ran a structured products company with a couple of partners. Two of them are here today, Michael Simonetta and Keith Crone, where we built up to about $1 billion, sold that to Fiera, which is why I went to go and run their retail business. And then going all the way back, because I do have some gray hair, I helped set up Jovian Asset Management, which was part of a mid-sized financial services company called Jovian Capital. They ran about 13 billion. I think anybody under the age of 40 will have probably never heard of them before. But I built up the asset management platform from zero to about $5 billion. And really the crown jewel that we incubated at Jovian was the Horizons ETFs, which today is one of the country's largest ETF providers. So I intersected in the ETF business a couple of times. And in 2016, when I was trying to figure out what I wanted to do next, I took a few months to kind of step back and analyze the space. I was 45 years old, trying to figure out whether I should go and build something again like I had in the past, or whether I should go and work for a large asset manager or a bank and build out an ETF platform for them, because I had a few of those offers. And decided that I did not want to slip into the warm bath of working for a large asset manager or a large bank and building up an ETF platform, because I figured that if I went into that warm bath, I probably wouldn't get back out, and decided I wanted to build something. And one of the things that I did when I decided to build Evolve was really putting together a team of people that I worked really well with. One of the advantages of getting older in the business is through your 25-year career, you meet a lot of people that you really like working with. You also meet a lot of people, unfortunately, that you don't like working with. So when you get to this stage, you're able to kind of pick and choose the people that you want to have on your team. So pretty much everybody here that you see has worked with me. Keith Crone actually has worked with me all the way back to the Jovian days, so about 20 years. Michael Simonetta has worked with me for about 10 years. So it's been a great team to put together for Evolve. We have a lot of registrations, so the OSC loves us. We are registered as a portfolio manager, an IFM, as well as a commodity trading manager. When we set up Evolve, we also wanted to make sure that we had top-notch service providers. Our legal counsel is Blake's. Our entire back office of our business is run by CIBC Mellon. E&Y are our auditors, and TSX Trust are our transfer agents. And then our index provider is Solactive, which I will touch on later in this presentation. So fast forward to today, and maybe I'll give you a little bit of history of the organization as well. We are currently at just over 3.2 billion in assets. We started this business 5 years ago. We hit our 5-year anniversary last month. We have been, if not one of the fastest growing ETF providers in the country. We have 23 ETFs, and a number of our ETFs also have mutual fund versions as well. To put this into a little bit of perspective, we started 2022 with about $2 billion. So we've actually grown this year by about 60% in assets, and most of you who are market students know it has not been an easy market to actually grow your assets. I believe we're probably the only one that can say that we've had this kind of growth. And I give a lot of credit, beyond our team, I give a lot of credit to the fact that we put together a really diversified platform of ETFs. When I started putting Evolve together in 2016, Most of my friends and colleagues in the industry called me nuts. They said it's way too competitive. How are you going to compete? It's way too low margin of a business. You're kind of silly to even consider it. And I've always been a big believer that no matter how competitive an industry is, if you put together a good business plan and if you execute it well, you can find success anywhere. And that's really what I think we've done a really good job of, is having a great team and having great products. When we did start the business back in 2017, or just prior to 2017 when we were putting our products together, what was really important for us was to identify where there's potential gaps in the ETF landscape. The two gaps that we identified were around disruptive innovation, so disruptive technology, which I'll touch on during this presentation, as well as actively managed ETFs. When we started looking at actively managed ETFs, I think most of you would agree that some categories or some asset classes benefit from active management. Others, perhaps you might be better off just buying a passive index approach to it. One of those areas that I think really benefit from active management is fixed income. But because we didn't want to pretend to be something to the market that we're not, which is fixed income portfolio managers, we wanted to go out there and actually partner with some of the best in class PMs that are available in the market, especially from an institutional perspective where we could bring them to the retail market. So we partnered up with Allianz Global Investors. Some of you may be familiar with that name. They are the sister company to PIMCO. They're also owned by Allianz SE, which is the world's largest insurance company and one of the largest asset managers. They're actively managing a global bond fund for us. We also partnered up with a fairly large local manager named Addenda Capital. Addenda is actually owned by the Cooperators Insurance. They are primarily an institutional operation managing money for most of the major municipalities across Canada. They're actively managing two funds for us, a Canadian preferred share fund, as well as a Canadian core fixed income fund. The disruptive tech category is really where we've gotten a lot of attention and a lot of press since we started the business a few years ago, and has a lot to do with the fact that we launched a lot of firsts in the Canadian marketplace. We launched the first cybersecurity ETF in Canada, which I am going to talk about as well in this presentation. And it's actually today the largest disruptive tech ETF in Canada. We launched the world's first actually, automotive innovation ETF. So, 5-6 years ago, when most people thought that Tesla was, or figured that Tesla was on the verge of bankruptcy, our view was that the future of the automobile is going through its biggest transformation, not just of our lifetime, but of history, around the autonomous elements, the connectivity, the electric, and the shared elements of the automotive sector. So we launched the world's first future of the automobile ETF. We launched the first cloud computing ETF, the first e-gaming ETF, the first diversified technology or innovation ETF. So as you can get the impression up there, a lot of firsts. We've won a couple of awards as well. The Fund Grade A Award and the Morningstar Award for Edge, which is our diversified innovation fund. And we also have a few cryptocurrency ETFs as well. So maybe I'll give you a really quick overview of the journey that we've had as it relates to growth for us. So when we launched our first ETFs back in 2017, cybersecurity, for example, was our first ETF, and then we followed up with a few others. And I think most of you who have a good grasp on business principles know that you typically have this 80-20 rule where 20% of your products are going to capture about 80% of your assets, and we were no exception to that. In our first year and a half, we got to about 500 million in assets, and most of our assets were in our Canadian preferred share fund. And then if you remember, in 2019, the Canadian preferred share market didn't fare too well, and a lot of people started to exit, and that was when it really became important to us to pivot our strategy. It worked out really well for us because what we started to do was focus a little bit more on our disruptive tech ETFs, where we had built this reputation for ourselves in the marketplace. And then, as many of you know, we fast forward to 2020 when COVID kicked in. Disruptive tech became top of the list for a lot of investors. Why? Because we got vaulted into this work from home environment. All of a sudden we realized how important cybersecurity is, or companies realized how important cybersecurity is. All of a sudden they realized how important cloud computing is from a perspective like DocuSign and so on. So all of these technologies started to really become very prevalent in the marketplace during COVID. And as you probably also know, we had some great performance in those disruptive technologies as well. So by 2020, we reached about $1 billion, just past 2020, we reached about $1 billion in assets. In 2021 was the first year where we actually had very balanced growth. And what I mean by that is we had growth in some of our fixed income, we had growth in some of our covered call strategies, we had growth in disruptive technology. So it was very balanced and diversified. If I could continuously repeat 2021, I think it would be great. And then of course we got to 2022. Market has been incredibly challenging, but HISA, which is one fund that I'm also going to talk about, our high interest savings account fund, cash alternative product, is what has really risen to the top for us. It's been a massive asset gatherer for us. Most of our assets or growth this year has gone into that fund, as well as some of our covered call strategies. So I think the important point that I want to get across is, for us, it has been really critical to have a diversified platform of products. And in addition to that, it's also been really important for us to have products that will resonate with investors or advisors, regardless of where we are in the market cycle. And that's what's been working for us for the last 5 years. One thing that's worth noting as well is that the way we will tend to evaluate our business is not so much on our assets, although we're obviously pretty proud of that, but also in terms of our shares outstanding. Because the one thing, as you all know, and I know, that we cannot control the market. So if our assets were to drop by $500 million, what's really as important for us is, because we can't control the market, we need to know whether we're doing a good job of defending our existing assets or growing other areas of the market. So on the left, you'll see our ETF assets. So to break down our assets a little bit for you, I mentioned before that we're managing just over $3.2 billion. Out of that $3.2 billion, just over $2 billion is in our ETFs, and about 1.2 is in our mutual fund sleeves. So on the left, you'll actually see our growth in our ETF assets, and on the right, you'll actually see, which is most important to us, our shares outstanding. So our shares outstanding for our funds have continued to grow. If you were to even extract out our HISA fund, our high interest savings account fund, which is our cash alternative fund, our shares have actually stayed pretty flat this year. So from our perspective, obviously it's always nice to grow. We always want to grow, but from our perspective, the fact that we've been able to defend our assets in a very challenging market has been an accomplishment in itself. So I want to really quickly talk to you about a few products before I wrap up and take any questions. As we look forward within Evolve, I think it's really important for us to kind of recognize that we're potentially entering a very different environment from an investment perspective. And so the kinds of products that we have in the marketplace need to accommodate that change. I'm not saying that, you know, we're not going to have a major bull market in the next couple of years. I don't know, but I think most people would agree that over the next couple of years, we're probably going to be in a challenging market environment. And so for us, when we look at our product lineup, we say, okay, what do we have within our product lineup that could actually resonate in that kind of market? Meaning, what do we have that can actually perform? Well, he says number one, which is our cash alternative product, because as you all know, cash is king. I'll give you an interesting stat. So far this year, there's been about $10 billion that has gone into fixed income ETFs in Canada. Of that, $5 billion, or 50%, has gone into these high interest savings account ETFs. These are very simple products. We take the proceeds of the fund, we deposit with 4 of the big 6 banks, so all the banks that you're going to know. We earn the overnight rate, which as of a half an hour ago has gone up to 3.75%. 3.75%. We take the overnight rate of 3.75%, and we earn from the banks that plus a premium of another 50 basis points. So right now, this fund is cash on deposit with 4 of the big 6 banks, earning 4.25%. Daily liquid, no lockup, no fees. So that's the reason why we've had so much growth. Why do the banks pay such a high rate? It gives them a diversified deposit base. It gives them access to other channels and geographies that they typically don't have access to. So these are the products that have captured a lot of the ETF assets, not just for us, but some of our competitors as well this year. We also have a US dollar version of it. very similar, except it's based on the US Fed rate. So the US Fed upper, which for now is 3.25%, plus we receive 20 basis points above that. So the yield is 3.45%. So when a lot of investors evaluate these funds, these HISA funds, and compare them to other alternatives, well, as many of you know, most fixed income this year has actually had a negative return. There's no risk to your principal here with these funds because these are simply deposits with the big six banks. Even short-term fixed income is down this year. If you look at GICs, they can be pretty tempting, but you have to be prepared to lock up potentially for a period of time. So when investors and advisors look at this fund, they say, well, from a yield versus liquidity perspective, there's no better options in the marketplace. And that's the reason why we've been gathering a lot of assets. On the equity income side, we launched these funds, most of these funds 4 years ago, where what we wanted to do was provide investors with exposure to specific areas of the equity market, and then layer on an option strategy or a covered call strategy on up to a third of the portfolio. I'm not sure how familiar everyone here is with covered calls, but effectively what they can provide is yield through the option premiums, as well as potentially cushion some of the downside risk that investors are wearing. Most of our covered call strategies are paying out anywhere between 7 and 11% annualized. We take a very simple approach to these funds. We'll take a look at a sector. In an example there, you'll see Life, which is our healthcare fund. We'll take a look at a sector like healthcare. We'll invest in the 20 largest global healthcare companies in the world, measured by market cap. That goes into an index, equal weighted, rebalanced quarterly. And then we have an active covered call overlay on up to a third of the portfolio. That fund, Life, is our largest. It's actually our second largest fund within our entire lineup, but of course the largest within the covered call lineup. And the reason I have it up there is not because it's one of our largest, but because if we look forward and we potentially are entering into a recessionary environment, well, healthcare is definitely one of those recession resilient sectors that exists out there, because regardless of whether people's purchasing power decreases, we all know that they still need their meds, they still need their medical equipment, they still need their procedures. We also know that we have an aging population. We also know that we have this emerging middle class across the world that has these major pharma needs and healthcare needs. So we think that this is a great area of the market. If you look back at the previous recessions that we've had, the last 3 recessions, healthcare has fallen half as much as the broad market and recovered twice as quickly as the broad market. So I think that as we move forward, and if we are potentially in a recessionary environment, healthcare is definitely one of the sectors to be considering. And our fund obviously generates some yield. Bank is also another one that has tendencies of recession resilience. Bank is a very simple product. 10 companies, so the 6 big Canadian banks plus the big 4 life cos in Canada, equal weighted, plus a covered call overlay as well. There is one little twist to this fund. We actually added 25% leverage to this fund. Levered ETFs have become quite popular in the last couple of years, modest leverage. When we decided that we wanted to do this, we were adamant about making sure that whatever we were adding leverage to had some kind of positive correlation to rising interest rates, meaning that when the borrow cost is going up because interest rates are moving up, is it an underlying equity basket that could actually benefit from that rising interest rate environment? I think most of you probably know that typically banks do benefit from a rising rate environment because their margin and their books improves. And typically insurance companies, they take those premiums and invest in debt instruments that benefit from higher rates as well. So that fund has definitely been getting a lot of attention for us. And then last fund over there is not getting a lot of attention, but I do believe will over the next year to 2 years, is our active REIT fund. And that is actually actively managed by Slate. I'm not sure how many of you would be familiar with Slate, but they're a fairly large local manager here in Toronto. They're actually part owned by Goldman Sachs. And they run about $13 billion, and we wanted to partner with them because what we feel about the REIT market is that perhaps it's not the best time to be marketing a REIT fund. It's probably a really good time to be investing in it, especially selectively. We think all REITs are not built equally, and that's the reason why we wanted to have active management in there. And then finally, something that you probably would not have thought about investing in a recessionary environment is our cybersecurity ETF. So, I wouldn't mind sharing a little bit about cybersecurity. Most people know that this is my favorite fund. I think everybody has their favorite child, even though they don't admit it. This has always been my favorite fund that we've had within our lineup. It's obviously our first fund as well. What I love about cybersecurity is that it has very strong tendencies of recession resilience within it. Right now, cybercrime is going to cost the global economy about $10 trillion. It's massive. But if you look at every Fortune 500 company, every government agency, every Canadian bank, you know that no matter how terrible their financial results are, especially if we enter a recessionary environment, the one area that they will not cut their spending on is cybersecurity. It is critical infrastructure for every major institution around the world. Every CEO of every major company has seen the case study of a company like Equifax. Equifax had a massive data breach of 143 million records back in 2017, and their stock dropped 35%. The CEO got fired, the board got fired, they lost customer trust forever. That is not what any Canadian bank wants to go through. That's not what any major Fortune 500 company or government agency wants to have to deal with. So it has a non-discretionary spend attached to it, which makes it recession resilient. Secondly, what a lot of people are not aware of is that it is one of the very, very, very few industries, although there's more now, that actually has a massive shortage of human capital. For the last few years, there's been a continued shortage of about 3.5 million people in the cybersecurity industry. So there are 3.5 million job vacancies. I often say to people, if your child is graduating or going into university trying to figure out a career path for themselves, it may be a very good career for them to consider, because there's virtually guaranteed employment. So because of that massive shortage of human capital, companies, banks, Fortune 500 companies don't have enough staff internally to take care of all their cybersecurity needs. I'll give you another stat. Our Canadian banks here, on average, have about 3 to 3.5 million attempted breaches per day. Per day, okay? Because banks are your mecca of companies that you would want to hack if you're a cyber criminal. So because of that shortage of human capital, what ends up happening is 75% of all the cybersecurity work that is performed for our Fortune 500 companies, government agencies, and so on, 75% of it is outsourced. If you're running a Fortune 500 company and you're going to outsource your cybersecurity work, you are not going to outsource it to a small mom and pop shop operation. You're most likely going to outsource it to the big, regulated, publicly listed cybersecurity companies, and that's exactly what makes up our portfolio. It's every publicly listed cybersecurity company in the world with a minimum market cap of $100 million, and that's still only less than 50 positions in the fund. So I know I threw a lot at you, and I think I'm going to have a few minutes for questions. If any of you are interested in any of our products or learning more about our business, we have a phenomenal website. Keith Crone is the creator of that. He heads up our marketing group, so feel free to visit it. We are now actually up to, we did a little count this week in terms of our penetration within the Canadian market. We now have 1,000 advisors across Canada who are actively using our funds, and we have 140,000 investors in our funds. So to give you a little bit of perspective on those numbers, there are about 9,000 advisors in Canada. So 1 out of every 9 advisors in the country are using 1 or more of our funds. And we all know there's a lot more than 140,000 investors in Canada. So the good news is for us is that we have a lot of opportunity going forward from a penetration perspective, and we're looking forward to growing our business. Hi.
Hi, great presentation.
Thank you.
My name is Ruby.
Hi, Ruby.
Formerly in the financial services. I have a key question for you, I think, especially on what you closed with, is how do you gain shelf space? Because banks and the big online brokerages have got that requirement of, know your product. And how do you put your HISA, for instance, on TD Direct Investing's site? Because they don't want to compete with you, but you need to perhaps, how are you going to penetrate that aspect? And how do you get on some of the bigger IROC brokers' platforms?
Great questions. I'll start with the overall distribution, and then we can talk specifically about HISA, because you're quite right. Most of the banks will not allow this product to be sold in their system, and I'll explain why in a second. But it is always a challenge to get penetration. What I love about the Canadian market, though, is that when you create an ETF and you list it, you are up and running on every advisor's system across the country day one. Unlike mutual funds where you have to go and go through an approval process at the dealers, ETFs are actually up and running day one. It's also very different than the US, because in the US you still actually have to apply. Once you've listed an ETF, you still have to clear through the dealers. We don't need to do any of that. So great that we're up and running, but there's 2,000 ETFs in Canada, so how do you fight through the clutter? It's tough, and it's increasingly difficult because the banks are continuing to build out more shelf space for their proprietary products. We are getting a lot of penetration within the independent dealer community, which I know is not the majority. Right now is about 30% of all of the assets in general is coming from the independents, the likes of Raymond James, Richardson, Wellington, Canaccord, and so on. The banks typically make up about 70%. So for us, what it comes down to is the hand-to-hand combat of going and talking to every single advisor that we can at the banks or non-banks to get them interested in our product. What you will often find with advisors is they are truly independent. Even though they might carry a BMO business card or a RBC business card, they often are truly independent. And they also know that they want to have that full mobility in their future, because maybe they're going to move to another bank or maybe move to another independent dealer. And so what they don't necessarily want to do is go and invest a lot of their assets into the UMA platforms or proprietary products in order to preserve that independence from their perspective. So it is easier for them to use some of their proprietary product, but definitely what we've seen is because that independence level, and there's a few advisors here today, because that independence level, we're on a level playing field. But then it comes down to the integrity of the product, how much volume you're getting, how much assets you have, your performance, obviously, so on. As it relates to the HISA product, it's been a really interesting journey with that fund. So, the only banks that you can actually buy HISA at are CIBC and National. All of the other banks have actually blocked HISA because it is a potential cannibalization to their own internal HISA programs. Our yield on our HISA fund, forget about today's rate increase, but up until yesterday, our yield in our HISA fund is about 1% higher than what you can get on an internal HISA. So it's a challenge. We have a lot of advisors going and complaining to their dealers, but it's not gonna work. And there's been lots of articles written about it, as you've probably seen in the Globe Mail as well. It's not gonna work. But they're doing this solely to diversify their deposit base and access other markets. Great example of National. I know I'm going to run out of time here. A great example of National is most of their deposits are so concentrated in Quebec that by being a deposit taker for our fund, it gives them a lot more access to Western Canada, Central Canada, and so on. Does that answer your question?
Yep. Okay, we have less than a minute for one quick question, and when I walk up, that's it.
Hi.
Hi. I'm Hirsch. My question is regarding to your option-based strategy. So in January, the markets are good. Option covered call works very good. It's an awesome strategy when the markets are neutral to bullish. And to generate that yield, you cannot sell or select a strike price very far out of the money. Now the markets have gone down, and if you're picking a strike price which is based on today's conditions, you are losing your capital there. But if you're picking it too far, then you're not generating that yield. How are you overcoming that problem?
I think we're going to have to take this. That is at least a 5-minute answer. I think we're going to have to take it outside, and I'm happy to answer it.